All right, great, everybody. Thanks for joining us. Looks like we're 9 o'clock on the button here, and we're going to go ahead and get started. I see people actually joining us as we speak, more attendees coming on board, so very good. All right, well, very good. Let's go ahead and get the show on the road. We're going to talk about secret option trading solution, trading options with autopilot. Doing this in just minutes a day. So if you've traded options, or even if you haven't, you're going to love this technology and what we're about to discuss. The webinar is being recorded. You will receive an email, so check your inbox afterwards. There'll be a link to the recording if you need anything to review, and it will expire Sunday night, so you want to make sure to take a look at that while you can. So remember, we're talking about speculating with options, and to speculate, we accept risk as speculators. We're looking to profit as prices move up, down, and sideways. That's what speculation is all about, assuming risk for reward. Speaking of risk, let's take a brief second here to look at the risk disclosure. I'll give you just a minute to look at that. It's important to take a look. All right, very good. Just remember that there is risk of loss in any trading. Only risk capital should be used, and past performance is no guarantee of future results. So a little bit of context. We're going to talk about trading and looking at the stock index markets. And here's Jeremy Grantham. He called the 2008 crash ahead of time. He said the stock market in the next 20 years is going to break a lot of hearts. You can't get blood out of a stone at these prices, it says. Over the long horizon, like 20 years from now, the US market could be delivering 2 or 3% real return. So with that said, it's probably fair to say that we need to consider all of the alternatives when it comes to investing and trading in different market environments. We can't expect the markets to rally 20% every year, year after year. So we're going to show you how to approach that. Remember, markets are always right. Let the markets tell you what to do, and it can be expensive trying to convince the markets that you are correct. That's a great book, by the way, Market Wizards. Ed Sequoia was featured in that book, so you should read that if you haven't. So we're going to look at a new approach where you don't always need to be correct, just a tool that takes minutes a day to use, something new, probably you've never seen before. So you don't always need to call the market direction. And with that said, let's look at our agenda here. We're going to look at a little bit about us, the 3 common barriers to successful trading, stock market indexes, individual stocks, look at probabilities, high probability options tradings. We'll have a live demonstration and trade alerts, then a special offer for you because it is a live webinar, and then of course our FAQs. A little bit about AltaVest. Since 1997, we've been an introducing brokerage firm. All of our staff are licensed with at least 25 years of experience. We're futures and options specialists, and we've traded millions of contracts over the years. We're regulated, of course, federally, and we have staff in California and Illinois. So what about that experience? Take a look at this graph. This is E-mini S&P 500 options. Look at the average daily volume there. It's about, I think about 8 years, from 8 years forward. You can see the rapid growth, dramatic growth in that space. We've been a big part of this in the last 2 decades, and we're going to talk a lot more about that and dig quite a bit deeper. So with all that experience we've learned along the way, things that work and don't work, and we've learned the hard way sometimes as to what doesn't work. And on the other hand, we kind of look at things optimistically, like Thomas Edison here. Maybe we haven't failed, but just found 10,000 ways that won't work. So we learn from our past, and we put that together in what we're about to show you. What do our clients say about us? I've been a satisfied client of AltaVest since 2001. Here's Alex from Italy. Says they really are professionals. I've been with AltaVest since the beginning, 1999, although it was 1997. Then who am I? Who's this chap here speaking to you? My name is Eric Gebhardt. I've been doing this about 28 years, co-founder of AltaVest, federally licensed, of course, since 1991. And I have my BS in Business Administration from the University of Southern California. Sometimes people want to know how you got started. Well, not really too profound of a story, but I was in school and we had an investments course, and that is my book. Actually, it's right behind me there. And so I found that actually earlier this year, and I was able to open it up, and there you go. There's the chapter on options, and those are my notes. And I remember at the time being very interested. We were looking at crude oil; it had doubled in value in about 2 weeks' time. You can see the graph there. The oil fields in Kuwait were on fire, and that was a pretty dramatic time. But nonetheless, it was very interesting looking at the futures and options space during that time. So that stuck with me. I did get involved with the mutual fund industry with my 6 and 63 securities licenses, but the options and futures markets kept whispering in my ear, and I was hired at an options trading firm where I was licensed, registered there, and that's where I learned all about option spread strategies. And the rest, as they say, is history. So let's get onward on with this. We'll go ahead and jump in. We'll use our time wisely. Feel free to take notes and put away that text messaging. And I know we all do it, but we'll get through this. I promise. I think you'll enjoy it and learn something new. We'll have a live demonstration as well as a live webinar offer. So stick around to the end, something worth over $18,000. We'll show you how to get on board for really next to nothing. There's also a 30-day guarantee associated, and you can even participate for free. So we'll show you how to do that. So with that said, let me go ahead and expand the screen here. We'll shut off the webcam so you have more real estate to look at. And then I will go ahead and get started with the 3 barriers to trading success. Contradictions. So here's an article one day that talks about Morgan Stanley is on recession watch. The bond market is flashing warnings. And then here's an article on Market Watch. There's no reason to fear buying the market at record highs. So that makes you scratch your head. Who do you listen to? So that's kind of a lot of noise, isn't it? So that's really the first thing that can be a hurdle. And how about this? Chasing past performance. We've all done this. Look at actively managed mutual funds. Maybe you just pick the ones that did the best. Well, how about this? There's something called recency bias. Here's an article here from the Morningstar called the Morningstar Mirage in the Wall Street Journal. Of all the mutual funds awarded a coveted 5-star rating, only 12% did well enough over the next 5 years to earn a top rating for that period. And then 10% even got a rock bottom rating. So here's what that looks like. You see 5-star funds converge to 3, 1-star come up to about 2. So everything over a 3, 5, 10-year period of time becomes a average performer. So past performance really is no guarantee of future results. So it is difficult. And why is it difficult to pick a mutual fund or a stock or an ETF? Because, well, first of all, you have to pick the correct market, then the direction, then apply the right strategy at the right time and at the right price. Then you have to close out that trade. You have to manage those trades at the right time and right price. It's a lot to ask. And it turns out here that maybe monkeys might be the best stock pickers. Here's simulated result, 100 monkeys trading stocks. Average monkey outperformed the index by an average of 1.7% per year. So there is the best trader. If you're looking for a good trader, you need to look up this chap here, this lady. Then emotions. This is probably the third hurdle. Believe me, we probably, anytime anyone's ever traded, if you have any experience at all, you can probably relate to this. The fear, the greed, the hope, the anxiety, all the pitfalls of emotional trading. It's not our fault. It's just the way we're wired. We have bad wiring. We have a built-in bias to make poor investment decisions, like chasing past performance or getting out at the bottom. So I think we can all relate to that. We unnecessarily overcomplicate matters, such as a graph like this. Not sure it's going to help anyone trade, but it looks great. So how do you simplify? How do you basically cross those hurdles? Let's take a look here, a little deeper look. Stock market versus individual stocks. So here are the indexes versus individual stocks. An index is representing an entire stock market over time. I'm sure you're all familiar with the big ones, the Dow, the NASDAQ, the S&P 500. we will focus on the S&P 500. It was the S&P 90 until 1957. So now there's 500 stocks in the index. Kellogg, Coca-Cola, Berkshire Hathaway, Chevron. It's considered by most to be the best representation of the U.S. economy and market as a whole. So there's the history of the S&P 500 going back 90 years. And I think that's indexed for inflation. Yeah, it is. So that is a almost like a 45-degree uptrend there, isn't it? But of course, a lot of volatility along the way, which is to be expected. So why would you want to track an index and not individual stocks? Well, first of all, it's convenient. You can just track 1 or 2 or 3 indexes, not thousands of ETFs, funds, and stocks. Then it's less volatile. A large stock index like the S&P might move 3% in a day, and that would be a big, big move. Individual stocks routinely move 10 or 20% or more in a day, and they're very volatile. This is Federal Express versus the S&P 500. You see the S&P in the blue line just kind of moving along, but meanwhile, Federal Express fell out of bed here, didn't it? Dropped, I think, about 20-some% in a matter of a few days. And then how about TD Ameritrade? Trades on the NASDAQ. See the blue line is the NASDAQ. And then all of a sudden, TD Ameritrade drops. It was down another 25-30%, I think. That was just about a month ago. So I'm sure you've all seen that. Nothing too profound, but they can also be non-correlated, move in different directions. Here's midday, just the other day, Visa up over 1%, and meanwhile the Dow is down fractionally. So index can be up, an individual stock could be down, or vice versa. I'm sure we've all seen that. Now let's look at probabilities. What do big companies, casinos, insurance companies know that we don't? Well, this is how they make money. They collect our premiums. They are paid to assume and manage calculated risk. So they're selling and managing time, but they also hedge themselves, and they are very patient and consistent in their approach. And they figure that the long-term odds will favor them, the probabilities. So they just use, quite simply, math, statistics, things like actuarial tables that lay out all the probabilities and things like expected return. And they're just crunching numbers and using math. So maybe we could learn from the best, and we'll show you what we're talking about in just a bit. But also casinos, that sometimes they're called the house, higher probability trading. Let's look at roulette and how that relates to trading. So there are 38 numbers on the wheel. Let's say you bet $100 on the green zero and you spin it 38 times. Well, if you do that, you could expect probabilities would expect that you'd win once, lose 37 times. So you'd win $3,500, but all the other spins you would lose $3,700. So your net loss would be $200 or $5.26 on average per spin. So that becomes the house edge. Your losses become the house gain, and that is their edge. They do this knowing that they will pay winnings out at times, but in the long run, they have an edge. So that's called the law of large numbers. The average of the results obtained from a large number of trials should be close to the expected value, and the closer to the expected value as more trials are performed. So you repeat this process enough, and those are the probabilities, and the math will play itself out. So let's look at an analogy here with baseball and base hits, not home runs. If you're not too familiar with baseball, don't worry about it. But basically speaking, if you're going to be playing baseball trying to hit a lot of home runs, you're going to strike out a lot. Or you could just try to get a base hit and reach base. So here's a batting champion with no home runs, and he won American League batting titles, most valuable player awards, and on and on and on. So he is hitting for probabilities, high probability outcomes, not trying to swing for the fences and hit grand slams and home runs. So what is a high probability option strategy? So you would collect premiums. We'd call these base hits, collecting relatively smaller amounts of money by selling specific options. Be consistent and patient, manage your risk. You know you will have losers. Manage the reward. Don't get greedy, but you need the proper tools. Remember, not swinging for the fences. These are called credit spreads, where you collect premium by selling an option. But we're doing insured positions. These are predetermined risk and reward, and they might be non-directional trades. So you have here the maximum reward is your net premium collected, minus your fees, of course. And the maximum risk is the difference between the short and the long option strikes, minus the premium received. And of course, add those commissions in too. But here's what this looks like. Don't worry if it doesn't make sense yet. Now remember, we're trading an option spread, that one net price. So you have multiple options combined in a trade, and it trades at one net price as one, what they call object. It trades as an object, so you might have 2, 3, 4, 5, or even 6, what they call legs in an option spread. And combined, what's the price of all those options together? And that is the spread price. So what are the advantages of a credit spread on a stock index? Well, something, that highly technical term called wiggle room. As we know, an index, a stock index, is less volatile than a stock. So it may move a lot, yet not adversely impact your spread position. So you can see here the stock market index kind of moving away sideways, moving a little bit higher. And we'll take a look at what this chart means in just a minute. And to do that, we're going to look at something called the Greeks. It's all Greek to me. If you don't understand Greek alphabet, you're going to learn a couple of them here. Pretty simple stuff. You can get really deep into this, but we don't need to. There's multiple Greeks assigned to options trading, meaning it's just the term used to describe characteristics of an option. So what does delta mean? What is that describing? It's the percentage change in option value compared to the change in the underlying asset. So what do I mean by that? So here's the December S&P at 3120. Here's a 3090 put at 15 points. The delta is 0.25. The December contract drops 10 points. Now it's at 3110. So what would happen to the value of this 3090 put if the S&P dropped from 3120 to 3110? Well, that option would gain 25% in value because of the 0.25 delta. Now it would be 18 3/4. Just that simple. At the money options have 50% delta, deep in the money 100%, deep out of the money very small, like 1, 2, 3, or 4%. It takes a big, big move to make a difference in the value of a deep out of the money option. So here's a secret. Some of you may not know, some may know, but it also equals the approximate probability of expiring in the money. So that's what delta also represents. So 0.25 means 25% chance of expiring in the money, and then a 75% chance of expiring worthless. So remember, delta is not static. It always moves with time and underlying price movement and does not represent the probability of a winning trade. So let's talk about time. What are we doing with time and options, and what does time decay mean? Well, markets might move towards the upper or lower boundary of a credit spread, but that spread still may not be adversely impacted. And that's because of time decay. That's called theta, or sensitivity to time. So time decay is something that applies to every option. It's a wasting asset with a limited lifespan. And you refer to this as theta, expressed as a negative number equaling 1 day of time decay. So here's an example. The premium is 10, theta is negative 0.05. So that means the next day, all other things equal, the premium is 9.95, and the day after that, 9.90, and so on. So every option that is out of the money will be 0 at expiration because of theta decay. So that's what gives the credit spread that wiggle room we talked about, and we'll show you that in the demo. So you have to take advantage of theta decay when you sell options. This is what it looks like here. Just a simple graph. As time gets closer to 0, the value of the option drops and drops and drops and drops due to theta decay. So as a credit spread trader, you want to be boring. You want that paint to dry, right? You want to be You don't want to be the life of the party. So the whole goal, your whole goal is to sell these out of the money credit spreads, collect the premium, and then watch time pass. And of course, it's never that easy, right? Because markets do move around. So we're going to show you how to manage all that. And here is our first example of a credit spread, a bear call spread, bearish to neutral. You sell a call, collect the premium, and then you limit your risk and you buy a higher strike price call with the same expiration. So here's an example. Here's the S&P. It's been moving up and up and up, as you know. Just keeps moving up. So around 31, oh, I don't know, what does it look like here? 3,100, 3,120 or so, something around there. And you decide to sell an out of the money call spread. So the red line is the 30-30 call that you sell, and you collect 4.5 points. And simultaneously, on the same order, you buy a 33.50 call, and then you pay 2.25 points. So that means you collect a net premium of 2.25 points, $50 a point, $112.50. And of course, you'd have to calculate your fees involved too. So that is just a simple example of a credit spread. And the put spread is the same thing, except with puts, of course. Here's the S&P. Remember, doing the same thing right above 3120, and you decide to sell an out of the money put spread. You sell the 2800 put, collect 3 points, and then you buy the 2780 put, and you pay $1 for that. So the net is $100 that you collect, including your fees, of course. And that is an example of the put spread. Now remember, these are not naked options. These are insured positions. Your maximum risk is capped. These are covered spreads. This poor cat here is naked, but we are not trading naked options. And if anyone wants you to trade naked options or suggests it's a great idea, you better rethink that. Here's an example. Here's the S&P trading at, let's say, 2,800. This is from a few months back, but that's okay. Now let's decide, you decide to sell a 25.85 put represented by this red line, and you collect the premium for selling this put. Because remember, at 2,800, that's pretty far out of the money. You know, what could possibly happen? You'll just sell that put and collect the premium and move on. Well, E-mini S&P drops and drops and drops down to 23.50, and you are still short that put in this example. You would be sitting on an open loss of almost $12,000 just from selling one naked put option and having the market go against you like that. So that's why you always want to sell covered spreads. In this case, you could have bought the 25.65 put, paid a little money, bought some insurance, and your maximum risk would be no greater than the 20-point difference between the two strike prices. So you can see 10 times less risk there by selling a covered spread. So that's the insurance we're talking about when we sell covered puts and calls. No naked options, that would be unlimited risk. And here's another advantage for the way we trade with covered options. You'll never have a margin call if people are trading naked options or uncovered spreads. Believe me, as the markets are moving, they're going to have to meet all sorts of margin calls if they don't already have the money in their account. So here is something called an iron condor spread. This is a non-directional strategy to collect premium. And quite simply, it's a combination of the put and call spread that we just saw. It's super easy. If you've never heard the name, don't let it confuse you. All you do is look at a stock market index like the S&P 500, and you sell calls above the market, call spreads above the market, and put spreads below the market, and you look for the market to stay in a range. So just an example of a typical iron condor, what that looks like. Selling a call spread, selling a put spread, and let's show you some examples here. Some of these, what we call our secret strategies, which are a variation on a condor. So if you've never heard the dragonfly, that's because it is our name, and that's really something unique to us. Now a dragonfly, and what I should have done is labeled these ahead of time, but that slipped my mind. But a dragonfly is essentially selling a call spread above the market and a put spread below the market, but there are actually 6 legs in this trade compared to 4. Let me explain that. you sell 4 of the 3180 calls. At the same time, you buy a 3160 call that's closer to the money, and then you buy 3 of the further out of the money 3220 calls. So you've sold 4 calls, you've bought 4 calls. So for every option you've sold, you've bought 4. So this is a covered spread, and the same thing with the puts. And the reason we do this is because this one that you buy here, it's closer to the money. So if the market were to move higher and get closer to this upper boundary, this closer to the money option would actually hold its value and actually gain in value quicker than the other options that are further out of the money. Because you own it, that can provide some different characteristics. And let me show you what we're talking about. And before I do that, let's look at something called a bear hedge. It's a directional strategy. So let's say you think the stock market is ready to correct or decline, and you have a portfolio and maybe you want to protect it. Well, here you go. Here's a great way to do that. You sell a call spread, receive a credit, then you use that credit to buy a put spread. You know, here's Ray Dalio, Bridgewater, manages 150 billion. I think they're the largest hedge fund in the world. Just recently, a week or two ago, he said, investors have been buying dreams rather than earnings. He said that situation will eventually have to be rectified. So reading between the lines, he's a little bit negative, to say the least, on the stock market. So if you feel like he does, then you'd want to have some positions that perhaps could do well if the market were to drop. And then also look at this, the CNN Fear and Greed Index. This is from a few days ago. I think the latest one is maybe in the upper 80s. But extreme greed, level of 91. I don't think I've seen it much higher than that ever. Essentially, that means everyone's bullish. And a contrarian would say, well, if everyone's bullish, who's left to buy? And therefore, you know, we're ready for a correction, or at least for the market to pause. So keeping that in mind, maybe you wanted to have a directional play in mind, such as this. So what you do here is you could sell an out of the money call spread, and with the money you collect for that, you can buy an out of the money put spread. And if the market were to decline rapidly enough and in large enough magnitude, then this particular strategy should do well. But this can all get very overcomplicated. I get it. How would you even know where to begin? What options to trade, which ones to get into and out of, at what price? I just captured this from the CME group. Here are E-mini S&P 500 options, just for one option series here. You can see the strikes down the middle, puts on the right, calls on the left. So how would you even know where to begin, which ones to actually buy and sell, the difference between the strikes, which expiration, what's the best pricing, and then of course once you're in it, how do you know where to get out? So there are a variety of expirations on the ES futures options. When I say ES futures, I mean the E-mini S&P 500. So we'll just say ES. You can see all the different expirations available. Lots of opportunities every week. But once again, how would you know what to do? Where would you start? What do you actually sell? What do you buy? Who are you selling to? What's a good premium? What's a bad premium? What about the win? How do you manage the risk and reward? Well, you would need to consistently automate your risk and profit management, be non-emotional, keep it simple. You want high probability strategies that you just repeat over and over. A liquid market like the ES options, and we'll show you that. Then we'll want to automate your risk and profit controls. And of course, you want to have the correct position size, and you want to stagger or ladder the strike prices and expirations. You don't want all your trades doing the same thing. So that leaves Maxwell Smart a little bit perplexed. Maybe that's a lot to take. How do you figure all that out? Well, that's what we're here for. We've done all that testing. Here's a fresh approach to trading complex option spreads. It's called Theta Trader. We built it to collect premium, but of course you can also buy premium, and we'll show you that. These are pre-built credit spreads. These are automatically generated credit spreads. And how does this work? Well, an algorithm will create theta trades every day, same types of sophisticated strategies that the pros are using, bull, bear, and flat market strategies. And then there's automated risk and profit controls and something called the RTI. So this is ThetaTrader, algo-driven option spreads and automatically managed spreads. Clients say it's a superb trading platform. You have minimal trading experience. You can enjoy the benefits of sophisticated trading. So if you like what we're about to see, we're going to show you how to take action in just a bit. So with that said, let me switch screens and we are going to jump into ThetaTrader. All right, you now see the dashboard for ThetaTrader. So let's go ahead, and this is just a demo account, so don't worry too much about all the data here on the right, the account info and all. But if it were your own account, you'd see your account balance and so on and so forth. And here are the pricing, the prices for today on these stock index futures that we follow. But really, the best thing to do is really start at the beginning. Let's look at the top for the theta trade. So an algorithm will generate these every day. Let me show you what I'm talking about. Here are the trades for a bullish outlook, or a bearish outlook, or a neutral outlook. And here are the markets. The ES, just place your mouse on that and you can see it pulls up a window. The E-mini S&P 500 is the ES. Then the mini NASDAQ 100 is NQ. And then the mini Russell 2000 is the NQ, and then the mini Russell 2000. But for the most part, lately we've been doing the ES, but of course you can trade the other markets, but that's most of the volume has been in the ES. And we've talked about in the run up here, mostly the selling premium strategies like the Iron Condor. So let's go ahead and take a look at that. You just click on there and now you can see ThetaTrader has already built the theta trades for today. These are what's available for today. Trades anywhere from 17 to 73 days till expiration. And you can see on any one of these here, if we click on it, let's go ahead and drill down and explain this. First thing I like to do is look at a chart. So this is an Iron Condor for the January end of month. And here's the chart, selling the 33.30 call, buying a 33.50, selling the 27.90, and buying a 27.70 put. And how did these get placed here? Well, the algorithm selected these strikes and did the work for us. So this is what this trade looks like. Gives a lot of perspective. You can see where the market's been in the last couple of months, and kind of in the mid-range here, selling the calls above the market, selling the puts below the market. So how does that work in terms of how could you actually place that order? It's very, very simple. But you can see here the market, days till expiration. Here's the expiration. Traded at last 2.2 points is the price of that spread, collecting a net premium of $110. The put risk, the call risk, the commissions. But look here, this is important here. This is the cash required to place the trade, about $900. And this here is your net profit potential, and that's about $90. So why would you put up 900 to make 90? Well, let's look at this. You're selling the 27.90 put, and that delta is 9.79. So remember delta, probability of expiring in the money. So that means the probability of expiring out of the money is over 90% if you sell this option. Now with the call, the probability here of expiring out of the money is more like 93%. So these are what we would consider higher probability outcomes. Remember the law of large numbers. You want to repeat this over and over and over and over, and over a long enough series, that's what the probabilities suggest. Now you have some numbers here. This is called the targeted return on cash, a little bit less than 10%. And then the another one here, targeted annualized return at expiration. But quite frankly, that is just there for comparison. Let me show you what I mean by that. You can see it up here. and you can see them ranked. And essentially, the spreads that have the least amount of time would have the higher TAR. But that's just really to compare one spread to another. You can't expect to make these types of returns because that would assume you're doing this particular trade with 17 days every 17 days, and we're winning every single time. So that's not realistic. But nonetheless, let's assume you wanted to place this trade. You can see it's pre-populated as a sell because you're selling a spread or you're selling a condor. And this is where you select the quantity. It's already defaulted to 1. Let's just say we're doing 7. And we're going to leave the pricing alone. You could change it if you'd like. You can also change any of the strikes if you wanted. But remember, the algorithm put this together for us. So we're going to go ahead and place that order. And there it is. It's a demo account. It just assumes you're filled at 2.2, and that is that. Now let me show you what all those colors and everything on the dashboard mean. And I think the best way to do that is with the trade simulator. I've already loaded some trades here. So here is an iron condor trade beginning on September 25. And what you do is use the buttons here to play or rewind, and you can watch the trading unfold. So let's go ahead and press the play button. Now you can see day by day going by, and it's green. That means good, all systems go. You don't need to do anything with your trade. And you can see here the market's moving from the P&L on the trade is negative, but now it's getting positive. It gets negative again. It gets positive again. That's pretty typical for a condor. Remember, we're selling time. So for this trade to really ripen and become more and more profitable, time has to pass. So let's keep looking here at what happens. And look at this, it turns blue. Now what does blue mean? Blue means it is now ripe enough to take profits. This position has generated enough profit. Theta Trader says, get out, take your profits and run. So you got in, the market chopped around, and at this point, it's time to take the money off the table, and you can automate this. So you don't even have to watch, and I'm going to show you how to automate it. So this is what I mean by automatic profit control. When the RTI turns blue, Theta Trader can automatically place an order and close out that position for you. Let's take a look at another simulation. Let's go back in time again. This is from 2017. Once again, everything's green, everything looks fine. You can see the trade is slightly profitable now. Has 49 days till expiration. Market is moving a little higher though, so look at this, it turns blue. So if you had the automated profit and risk control in place, at this level here it turned blue, would have placed an order, and perhaps you would have closed that trade out for a profit. But what if you didn't? What if you just were hanging on to that because you thought you want to get every last bit of profit remaining from that position? Because at this point here, you've reached a little over 71% of your potential gain. And you think, well, maybe I could go for 100%. The market looks kind of quiet. Nothing's going to happen. I'm just going to hang on and just try to capture everything that I received and keep everything I received. Well, now it turns yellow, which means a little bit of caution is warranted. The RTI says, you know, a little bit of a slowdown type of thing, like a traffic signal. And also the trade went from green, positive, to negative. Now it's losing a little bit of money. There we go. My mouse is sensitive. Goes green again, goes yellow again, and then it turns red. Look at that. It's getting too close to that upper boundary where you're now short that 25.80 call. It's almost at the money, and it turns red. So had you stayed in that trade, you could have taken a winning trade and turned it into a losing trade. That's why we like to get the emotions out and automate this process. Now let's go ahead and look at this one here. Here's another iron condor. You can see here turning all sorts of colors, yellow and orange. Orange is just more elevated risk. Goes to green, and then look at this, it turns red. What does red mean? the trade's losing money, there's too much risk, close the trade and move on. So if you, once again, can automate this process, if it turns red, Theta Trader can automatically close out your position for you. You can take your lump and move on to another trade. So that's an example of how it manages risk. And now let's look at something called a dragonfly. Now before I do that, I want to look at an example here. We looked at a condor, now let's look at a dragonfly. Here are the dragonflies for today. And let's take a look at this on the graph. So here we are selling the 4 at the 33.30 calls, buying 1 32.90 and 3 33.80s, and then selling 4 27.90 puts, buying 1 28.30 and buying 3 27.40 puts. So that's what the dragonfly looks like. If it looks complicated, it's not. Pretty simple, really. You can see it broken down here. You can see it has 6 legs, 1, 2, 3, 4, 5, 6. And you're selling 4 puts and you're buying 4 puts, 3 and 1, and you're selling 4 calls, and then you're buying 4 calls, 1 and 3. Now, here are the deltas on all the options we're trading, and we saw how that works. But let me point out something here. The cash required is about 51.50, and your profit potential is about 350. And the T-Rock, total return on cash, is about 6.7%. That's a little bit lower than on the Iron Condor, which was about 9-something%. And so this has a slightly different risk-reward characteristic in that the reward is a little bit less typically, but the trade itself has a little more, let's say, stability at times in certain situations where when a condor might come into trouble, the dragonfly will not. So let's go ahead and just, let's say we're doing 2 of these, and the pricing you can see is at 8.65. It's higher, of course, because you're selling 4 puts and 4 calls. We'll go ahead and place that here in the demo account. And there it is. So now that you've seen what it looks like on a Theta trade, let's look at an example here on a simulator. Let's go ahead and see what happens. Once again, looking similar to a condor day by day, and the trade turned profitable pretty soon or pretty quickly. And there we go. Look at that, turned profitable, and there's still 34 days left in the trade. And then Theta Trader said, get out and move on. Now let's take a look at that exact same trade. Remember, this is placed on Valentine's Day of this year. So let's look at a condor. If you placed a condor on that same day, Valentine's Day of this year, let's see what would have happened. Of course, the market's doing the same thing. Now remember, we've got, what, 28 days left here, but on the Dragonfly, at 34 days and 33 days till expiration, it already gave a signal to take profits. It had reached profitability enough and ripened enough to take profits. But on the Condor, it still hasn't reached a point where a Theta Trader says to get out and take profits. So look at that. It finally takes a profit with 2 days remaining. So you had to stay in that trade almost over 30 extra days before it reached profitability on the Condor. So that's kind of a difference between a Dragonfly and a Condor. And the reason why is, as the market was moving higher and higher, remember this call in the blue line here is one that you bought. So you own that call and it's gaining in value. It's just not, and it's not losing time as quickly because it's gaining in value quicker. And that makes the difference. And in this situation here, it just takes longer to ripen. And let's look at another simulation the bear hedge. Remember we talked about a bear hedge where you sell a call spread and you buy a put spread at the same time. So if you think you're bearish, or if you are bearish, you could do something like this. And you can see here turning this light blue color. So when you are long an option spread in Theta Trader, this is a signal for reaching profitability. Theta Trader says you can consider closing out this position for a profit. So you can see how that works. And of course, if you, I don't remember what happens here, but yeah, look at that. It turned right around. So this was your chance here. The market did what you wanted it to do. It dropped. The position turned profitable, gave you a window here to close that out for a gain, but of course, unexpectedly turned right around, and then the trade basically loses money from that point forward. But anyway, so that's the bear hedge. So that is a good rundown of the simulator and Theta Trader. And I want to show you this here. Let's look at your open positions. So not only can you see your open trades on the dashboard, but you can see all of them here at once on the open positions page, and it's super easy. A big part of Theta Trader and the design was to make it easy to track each trade. Each one of these lines is a particular trade. So here's your entry date, days till expiration, all the different metrics on the trade. And this is just a demo account, and you can look at the graph on any trade. And then of course you can see here, if I squeeze my screen down, I kind of have it large, but you can see the RTI on all the trades at a glance. So those are the open positions, and then here are closed positions. Super easy here, very user friendly. I'll show you what a brokerage statement typically looks like compared to this. So you can see all the closed positions on this page. There's 20 of them here, 17 winners, 3 losers, total profit and loss. There were 19 short option spreads here, 16 wins, 3 losses, 1 long spread that was bought, that was a win. So these are all the closed positions here. You can see them. And of course, this is just a demo account, so it's just me going in when I'm doing webinars and selecting any trade. I'm not putting any too much thought into it. So nonetheless, that's how easy it is. Now let me show you this. You go up to the section here, and then you click on settings, and you'll see this is where you would activate your risk manager here. Check the box. Activate the profit directive here, check that box, and then Theta Trader will close out those positions for you when those risk and reward thresholds are reached. Now we also have a help file and tutorials. These are videos and also education videos if you need to refresh your memory on anything about options. And then also here is our proprietary research called TradeScope. Something that's done every day. Technical analysis on essentially the S&P, the NASDAQ, and sometimes the Russell. So you can see here, here's the S&P, some of the indicators we look at, and then here, technical review, and then a market outlook as to what to expect. So we do that every day. That's proprietary to Theta Trader. There's also the daily trading summary. That's more of a narrative or an editorial, or not an editorial, it's a narrative, I should say, of the day's activities, what happened overseas in the Asian markets, European markets, and what to look forward to with the economic calendar. So that is also part of Theta Trader, more proprietary research for you. Now let me point out this as well. There's something called the Trade Builder. So if you had an idea on a trade, you can select the market, select the strategy. It's all right here, and then just follow the prompts and click next and build your own trade. But quite frankly, most everybody follows along with the Theta trades. That's the whole point, to make it easy. The algorithm is obviously objective about it. So it's choosing these trades based on various parameters and variables. So that is a good example of Theta Trader. Let's see if there's anything else here. This is where a lot of good stuff is under the My Account section. Here's the dashboard, super simple. You can see at a glance when you log in how all your open positions are doing, any open long positions here. And of course, if you want to dig deeper, you just go to your open positions. If you want to look at the history, you go to the closed positions. And then here is the simulator. I'll show you that real quickly. I had some preloaded, but it's real simple to use. You can play with it for hours. You can go back in time and look at different situations. So really, you just go ahead and select a date. I don't know, let's just, June of whatever, any day. And then from there, you can determine if you wanted to do a bullish or bearish or neutral strategy, and then go ahead and it'll simulate the trade for you. So with that said, let me show you what I think is really the best feature of all. Let me switch screens, so just a moment. Okay, here we go. So hopefully that didn't overwhelm you. It makes we're going to make it even easier. I think this is probably the best. Well, it's hard to say the best. It's good stuff. You'll see what I mean. This is the best feature, maybe, according to some people. These are the trade alerts. This is 1 minute trading. And what do I mean by that? How is that possible? All you do is touch, accept, or reject when you receive that alert. It's that easy. One touch trading. These alerts are integrated. These are live alerts, and they are integrated with your AltaVest trading account. So if you like what you see, you just touch accept, and we handle the rest. If you don't like it, you touch reject, and that's it. And then once your trade is filled, the RTI will automatically then track and manage the trade, just as you saw in the demo, if you check those boxes to have the RTI working for you. Here's what it looks like. You receive a link. You can see the graph. Very simple. There's a condor. Let me point out something here. Premium collected, cash required. The quantity is already set for you because it's integrated with your account. Obviously, it knows what's in your account. Let me go back, start that again. Days till expiration, your targeted annualized return there. And that's it. Let's look at that one more time. And of course, this could be a condor, it could be a dragonfly, it could be a half condor, half dragonfly. I mean, it could be a bear hedge, bull hedge. What do clients say about the alerts? For someone with a busy life who doesn't have time to sit in front of the computer, AltaVest is perfect. The best thing about AltaVest are the trade alerts. So remember, screen watching, you don't want to be like this guy here. You've got your own stuff to do, own vacations to take with your family. We understand. So hopefully this was time well spent. I think it was. You discovered something unique, something maybe you've been looking for but didn't know existed. So here is a special offer with everything you need to get involved with our elite membership. Of course, the Theta Trader platform, you just saw that. The Theta trades and our algorithm building those option spreads for you. Simple, effective trade selection. Then here's trade tracking. How simple is that? Your open sold positions are just line by line. You want to look at any one of them, you just click on it and drill down. How does that compare to this? This is what a typical statement looks like from a brokerage firm. It's a nightmare compared to that. No comparison. In fact, that was probably half the reason we put Theta Trader together. It's just miserable years ago trying to do this without a platform like Theta Trader. Then there's the RTI. Take the emotions out. Automatically exit those trades. Put things on autopilot. You don't want those emotions involved. That's how you do it right there. check the risk manager, profit directive. It is that simple. Client says, I've been doing iron condor trades for 6 years. Your indicator is the best tool for monitoring trades. And here's that simulator. We saw that about, what, 4 or 5 simulations we did. Use all the buttons here. Go backwards in time, forwards in time. Make a fun game out of that. The trade builder, you saw how that works. So you have the theta trades, the RTI, the simulator, and the trade builder. Yearly value software like this is expensive. People are charging tons of money for this type of thing. That's well, it doesn't even exist. I don't think there's anything like it out there in the marketplace, but software is expensive. Yearly value of $35.88. Now, how about this? With the Elite membership, you have your private coach who is a licensed trader, one-on-one training with an experienced trader. So you have 1-hour sessions learning about index selection, theta trades themselves, the simulator, diversifying the trades, trade setups, analysis, the trade alerts, advanced strategies. So this is what you get with your Theta Trader Elite membership, all included with a licensed trader, someone who's been doing this for over 20 years. These are not just people, on a robot on a text messaging thing. Now, this is extremely valuable, these sessions here. You have a co-pilot, develop that relationship. They're going to know your trades, know your trade history, know your attitude towards trading, a value of at least $7,500, at least. I know that I've seen some firms offering education. They're charging $25,000 and higher just to learn how to trade options. But with us, that's included with your Theta Trader membership. Now, those trade alerts are integrated with your trading account. Remember, these are one touch, accept or reject. Very simple. Can't be, we really can't make it easier for you. These alerts, yearly value of at least $44.64. I get messages all the time, people selling alert services. There's monthly fees, there are quarterly fees, there are yearly fees. They're very, very expensive. And you know what? They don't even work as well because once you get an alert, you have to log into some platform and then copy the information into your platform. It's a mess. And how do you get those alerts? You just go to your settings and click right here. I want to receive my alerts. I love the trade alerts. They help keep me informed when I'm traveling. The staff is always there to help when I need more. So this is what you're going to get with the Elite membership, Theta Trader platform, the private training, the trade alerts, total value of over $15,500. So if it could be the one thing that saved you all the time and the money and hours of aggravation, get cancel subscription, it would be worth it, definitely. So how about this? Remember, we offered even more than that. We talked about the TradeScope proprietary research, the daily comments. That proprietary research is free as a Theta Trader Elite member. And then the online video tutorials, that's also built into Theta Trader. That's all part of the package. So you have Theta Trader, the training, the alerts, the research, then the online videos, $18,500 value. Even at half price, it would be a great deal. Absolutely, it would be. But we're going to over deliver. This is a live webinar. We appreciate you joining us so we can provide everything you need for only one-time payment of $997. People ask all the time, is this monthly? Is this quarterly? Is this yearly? No, one-time payment, become an Elite member, $997. But it is live and we'll want to encourage you to take action. This is what we're going to do, 20% off if you act until through Sunday night, $797, one-time payment. This is what people say about the Elite membership. The brilliant algo system never failed me, and neither did my helpful AltaVest advisor. And here's what the order form looks like. $797 one time, get that 20% discount. We know how it is. We do the same thing. I do the same thing. You like a deal that you're being presented with, and you think, I'll get to it later, and you never do. So now is the time to act. You see the link right there. That's what the order form looks like. Encourage you to take action here, and you have nothing to risk because there's a 30-day guarantee on your membership fee. And if it's 29 days from now, you decide you don't want it, that's fine. If it's not for you, we won't argue. So one-time payment, $797. It's a one-on-one boutique style of service. So we can't have, thousands of people wanting us to service their accounts. Just don't have the ability to make that happen. But take a look at that one time, $7.97. Now here's how you can get it for free. $100,000 or more account, we can refund that membership fee. Ask us for details. So come on board with the Elite membership, and that's how you come on board for free. We always get this question, trading account, can I do an IRA account? Yes, you can. Of course, individual, joint, corporate, LLC, trust accounts, all that good stuff. Now here's a section, now stay with us here because there's some good stuff here, and then also FAQs. I bet you didn't know, that's what we call this. Here are the advantages of ES futures and options. In nearly every trading scenario, ES futures contracts are a more cost-efficient way to manage S&P 500 exposure compared to ETFs. There's a study there from the CME Group. You can see the link. Significantly more daily liquidity at 8 times the value of all S&P 500 ETFs combined, including the SPY, the IVV, and the VOO. Traders are fleeing the individual stock options market. Customers pulling out of equity options and trying to trade other products. Customers are shifting to futures contracts. The OCC data show a 42% increase in futures volume during April. That's from the Wall Street Journal article there. You can see the link below. And it says here, with the individual stock option market, the bid-ask spread has grown 30% in the past 5 years, peaking in 2014. That's from that Wall Street Journal article. But meanwhile, let's look at what happens on the ES options. They have tight spreads, and let's look at the order execution quality. A report from the CME Group concluded that on average, the ES options offer superior execution relative to SPX. ES options offer cost savings of $4 to $15 per contract. You can see the link there to the study if you want to read all the details. So here's what they're talking about. The spread, the bid offer spread or the bid ask spread when you buy and you sell your options. You want that to be really, really narrow and tight to limit your transaction cost or your slippage. So what about the hidden cost of securities trading? I'm sure you've all seen lately that the big brokerages are going to zero commissions on their stock trading. Is it really free? No, it's not. The cost is opaque to the customer. There's something called payment for order flow. I'll make it real simple. It can get really confusing if you've heard that term. If you haven't, it's really easy to explain. So the stock brokerage is paid by a third-party market-making firm so that the brokerage will route their orders to that market-making firm so that firm can then execute the orders for the stock brokerage. So that leaves your order ripe for exploitation. So what do I mean? This can result in less favorable fills to the retail trader, costing you more money, but the cost is buried in the transaction. So here's an article called Robinhood Making Millions Selling Out Their Millennial Customers to High-Frequency Traders. They're well on their way to making hundreds of millions of dollars in cash income by selling their customer orders to the HFT meat grinder. High-frequency traders are not charities. The only reason high-frequency traders would pay Robinhood tens to hundreds of millions of dollars is that they can exploit the retail customers. That's an article on Seeking Alpha. So you can read that for yourself, all the details. But the point is, as our parents always told us and grandparents, there's no free lunch. So when things are sold as zero commission, that may be true, but when you place your orders, there's cost involved, believe me. So with E-mini futures options on the ES, there are no hidden costs. It's not a securities option. Trades on the CME Group exchange, on the Globex exchange. It's an electronic market for everybody, large or small. One marketplace. There's no payment for order flow. Equal treatment. Also, maybe you didn't know that futures options are tax efficient. They're treated to the 60-40 long-term, short-term cap gains rule. And individual stocks, meanwhile, those are all taxed at the higher 37% rate. Let me show you what I mean. Here's an example. You're trading individual stock options. You have 100 grand. You get a 20% return. Your tax would be, in this example, $7,400 for a rate of return of 12.6%. But if you're trading futures options, you have the same performance. Your tax liability is $5,360, rate of return of 14.64%, a difference in a savings of over $2,000 just because you're trading futures options and not individual stock options. And also losses can be used to write off gains or roll backwards, so you want to consult a tax advisor for details. And remember, there's no itemizing when you're trading futures options. You just receive one number at the end of the year, which is your profit and loss, your P&L. You plug that into your 1090, your taxes. You just don't have to do any wash sales or anything like that. What do clients say about all this? We call them our sticky clients. I've had an AltaVest account for 10 years. Trade alerts concluded suggestions on a wide variety of types and combinations of trades. The staff has been invaluable in continuing my education in trading index options. I've been an AltaVest for 13 years, been a professional team, AltaVest client for 15 years. So act now. Takes a lot of value there. You act now. And if you do nothing, of course, that's risk and reward free. A membership equals tremendous value with that elite membership. AltaVest has exceeded my expectations with their pre-selected theta trades. Responding to an alert takes but a minute or two. A chart and parameters are provided. I do not need to spend time at my computer. Well said. So here are the summary. Theta Trader, the training, the trade alerts, the trade scope, the education, tax advantages. And how about some FAQs? Can I trade stock options with Theta Trader? No, we specialize in options on E-mini stock index futures. And why do we do that? Well, we talked about the growth and the volume and liquidity in the E-mini markets. And then the benefits like tight spreads. We can just track a few, one or two markets, not thousands. And we have a clear defined cost structure, no hidden fees. It's not opaque. Can I use Theta Trader and the alerts with my current brokerage? Well, we are a brokerage firm and Theta Trader is our proprietary integrated service. And what is Theta Trader's performance? Well, remember, Theta Trader is just a trading platform and it's for self-directed clients who would make their own trading decisions. So if you're using Theta Trader, you decide on the trades you make or don't make. And then also remember too that all the calculations within Theta Trader, those are all net of the trading cost. So speaking of which, what are the commission rates? Our rates are very competitive. Our E-mini rate is $5.25 round turn all in. Let me stress that's round turn all in. That means total, nothing on top, no extra fees. So go to other sites, big brokerage firms, and then you might see a rate for, remember, futures options. This is not stock options. They might publish a rate like $2.25, but remember that's per side. Then if you read the fine print, then they add more fees on top, and that makes the total actually higher than what we're charging. So with that said, how much money should I start trading with? Well, we talked about the Condor and the Dragonfly. You need $1,000 about, and about $5,000 for the Dragonfly. So you'd want to have your trades spread out. You want it diversified among markets, expirations, and strikes. They call that laddering. So we suggest a minimum of 25,000. So remember, we talked about taking action if you liked what you saw. Here is your opportunity, cf.altavest.com/TT Elite. There's also our phone number. And remember, we talked about those hurdles, contradictions in the marketplace. Well, you don't need to worry about that with Theta Trader. There are non-directional strategies. Chasing performance, nope. We don't rely on any benchmark of any kind. And emotions, well, we saw how we can automate our profit and risk control and remove as much of that emotion as possible. So there you go. There's your lifetime membership, Theta Trader Elite, $797. It's a bargain. And remember the 30-day guarantee. Get that 20% discount, expires Sunday. And there is the link. And that is going to bring us to the close here. So I appreciate your time being with us. I'm glad to be here. And if you have any questions, comments or feedback, give me a call. There's our phone number. Love to hear from you. And otherwise, you see the link there, and you can become an elite member and get yourself started, and we'll get you onboarded with ThetaTrader, and you're going to love it. All right, thanks. Bye-bye.